Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's Q&A session. And the first question is, I'm going to call him AJ because that's what he's asked me to call him. It's not his real name, but just to preserve his privacy. And AJ's given me a whole bunch of details about his personal situation in terms of income, high income earner, package about 230 plus. AJ gets some employee shares around $30,000 to $50,000 a year. His wife earns 220,000. So, family income about 450, 500,000, pretty considerable, of course. Owns 4 properties, 3 investments, and 1 home, of course. All done really well. Says they're all in Brisbane within 10 to 15 Ks from the CBD. Has 450 grand in an offset account attached to his home loan and about 230,000 in super for him and 150 for his wife. And I should say they're mid-30s in terms of age and stage of life. And he's got a bunch of different questions on his situation. What I'm going to try and do what I try and do always is try and answer AJ's questions, but also widen the net a little bit so that anyone that's listening that might be in similar position, maybe not in totality, but for these specific questions, then at least they can learn something. So the first question that AJ has is that he gets employee shares from his employer. And he's asking kind of, what do I do with that? Should I diversify? So as a general rule, I like to diversify. Now, I'm not going to necessarily blindly sell every time if they're RSUs or shares, whatever they are. But every time I have the opportunity to sell, I'm not necessarily going to take it. And it's also not a black or white thing, I should say. As in sell 100% or keep 100%, you might find a bit of a balance. But as a general rule, we would like to get to zero, or at least as close to zero as we can, having consideration to the tax consequences and those sorts of things. So, for example, if I worked for CBA today, I would be selling because I think the price is really high. But if CBA's shares were to drop 50% tomorrow and I thought that was complete nonsense, then of course I wouldn't sell in that situation. I'd hang on to those employee shares, and when I thought the share price had recovered, I would sell. So, and the reason for that is that you don't want a lot of your wealth, your personal wealth, and therefore your future financial decisions hinging on the company you work for and the industry you work in. You're already reliant on that company and that industry for your income. You want to diversify where your investments are. Now, you don't necessarily have to go down to zero. You might want to still have a position there, but I don't think it should be a material position. And any shares that you continue to own, you've got to it's got to be money that you'd be happy to lose. It's a funny term, that happy to lose. No one's happy to lose money, but do you know what I mean? It's got to be something that if it went pear-shaped, it's not going to upset the rest of your financial plan. So I think AJ has, around what I can glean from the information, about 180,000 of these employee shares. Yeah, I would definitely, in your situation, be reducing them. And I think it links in with other questions in terms of what you want to do with property. But that's the general methodology there, I guess. Now, if you are going to keep employee shares, I should add, and it's not specific to AJ's situation, but if you are going to keep them, one of the things that you can think about, which we've done for some clients, is if they're like RSUs and they get allocated, they're in escrow and they come out of escrow, that tends to be the taxing point. And that's typically included in your taxable income in that year. So there's the cost base is the market value. Therefore, what we tend to do is move those shares out of that person's name, either into a family trust or into their spouse's name, but into somewhere that we think is going to be more tax effective, that gives us the ability to kind of stream income. In AJ's situation, both him and his wife are in the highest marginal tax rate. Maybe nothing you can do there. Maybe a family trust if you thought that you're going to hold those shares for a long time. But I just thought it was worth mentioning, I should say. Okay, next couple of questions relate to AJ's properties. One of his properties was purchased in 2016 for $390,000. and bulldozed and rebuilt that asset. I think it's a house with a granny flat. And the value of the improvements, about $1 million. And they expect about $1,200 a week from that asset. And I think that they're in the process of doing it, near completion, so it hasn't completed. And so AJ's asked, what should we do with this asset? Should we move in for 1 to 2 years to minimize tax and then sell and reinvest? I don't know if moving in is going to do anything with respect to minimizing tax, because when you've still got the cost base element an issue in terms of your tax cost base. I guess it depends on, well, it would have been rented since 2016. So, it's not going to change the capital gains tax calculation very much, unless there's a massive change in value over the next couple of years, of course. But as a general rule, what we're doing in this situation is, or what AJ's done, in 2016, he bought a land heavy asset essentially for 390,000. Now the land value has probably changed considerably for that asset, although AJ's suggesting that the end value is 1.6 and he spent $1 million. So actually maybe that land value hasn't changed very much. It might be 500,000 now based on what AJ's telling me. But the point is that you're changing the nature of the property asset. AJ in 2016 bought a very land heavy asset, and now it's a building or improvement heavy asset. He spent $1 million on it, the end value 1.5. So 2/3 is building value, 1/3 is land value. And that's reflected in the high rental that he's going to enjoy from that property. That's an indication. And I think just for someone in their mid-30s, it's not the right type of asset for AJ to hold. So, and the reason that I say that is you've got to think really in 20 years' time, when AJ looks back about his decision with his property, when he looks back, what will he reflect on? Well, he's going to reflect on the capital growth. And an asset that only has a third amount of its total value represented in land, and especially given if it really is only worth $1.5 million after he spent $1 million on it, and he bought it in 2016 before that Brisbane market kicked off. It was sort of late 17, it started to do that. And the land values therefore only changed from around 400 to 500,000 over that time. You can't argue with that evidence. That's pretty strong evidence. It has underperformed the market. So AJ, I would get rid of that investment. Take your money and run. Okay, you might have to pay capital gains tax, those sorts of things, although you've got a pretty strong cost base there, so you're probably not even paying too much in capital gains. But yeah, I wouldn't keep that asset because it's going to be income heavy, growth low asset, and that's not right for someone that's in their mid-30s. Okay, next question is, do individuals like myself benefit from the 4% build to rent scheme? So the government has this build to rent scheme in Australia, and you've got to have at least 50 self-contained dwellings to be available to the public. So yeah, it could be to individuals, but you've got to build 50 dwellings. Probably not the right way to go. Look, the build to rent, that's an interesting industry, probably another subject for another day, but I wouldn't be interested in doing something like that myself. Now, the next question is about their third investment property, which they purchased in December 23 for $950, is now worth 1.1-ish, and they've obtained a development approval to subdivide that asset. And AJ's question is, what do we do? Do we sell it with a DA? Do we proceed with the DA, do the subdivision, build on one lot and sell on the other? Now, I don't know if this subdivision means that they keep the existing dwelling and they're just building at the rear, for example, or whether they need to bulldoze and build 2 new dwellings. Doesn't really matter for my answer. But again, just for people that are attracted to buying an asset that is economically leaning towards some sort of development approval project, what should they do in that sort of situation? And of course, the answer is going to be different for everyone, both from personal circumstances and also then from property. No two properties are the same. But the things that I would look at in this situation is if I sell it with a DA today, maybe, for example, on a long settlement, or be flexible with the settlement terms, because then I can attract a builder that is willing to do that project but fit in with their time frame. How much profit will I make? versus if I go ahead and do the subdivision, how much profit will that deliver? And you need to do that financial analysis, and you need to get someone, accountant that has a lot of experience with that, or someone like that that can do that financial analysis for you and use meaningful but conservative assumptions. Make sure you obviously allow for overruns, these sorts of things. And those numbers will tell you which is the right answer. I find typically in many situations, you're going to generate a lion's share of the profit, 50% or more, just by selling it with a DA, and you don't have any of that development risk. And I reckon that's a pretty good outcome, particularly if you don't, one, have the experience of doing subdivisions and small scale developments. And the experience is also about having a team, of people that you can trust, architects and builders and these sorts of things that you can trust to do all that sort of work, engineers. And then you don't have the time, if you don't have the time to manage that or the inclination to manage that yourself, then you might be actually better off if you look at the risk-based return or risk-adjusted return. You're better off maybe just to sell it with the DA, but you've got to look at those numbers. I would only do the DA if I was going to be rewarded for it. And again, you've got to have that experience, you've got to have the inclination to do it, you've got to have the time to spend, all those sorts of things, the appetite to wear some of the, potential challenges that come out with something like that. Now, let's pretend that AJ goes ahead and does the DA, bills at the rear, whatever it might be. Anyway, he's got 2 dwellings because he's then asked, well, what do I do? Do I sell one, keep one? Do I sell both? Again, you've got to form a view on what will the future growth of these assets look like. And to hedge your bets, you could go, look, I'll sell one, keep one, and just see how it performs over the next few years. And if it's not performing at a level that you hope or expect, then of course you can get rid of it down the track. If one is going to have more land value than the other, or be positioned so that it has sort of better light or better security or these sorts of things, then of course maybe that's the asset to keep and you get rid of the other one. But it really is a project-based decision. I think the best thing that people can do is really surround yourself with a great team. Unless you have heaps of experience with this, it really is about having a great professional team around you, and they can save or make you a lot of money. Now, the other question AJ's asked about, potentially buying a property in Melbourne, what do they do if he ends up selling the one with the DA and the one that he's just developed? Of course, it'll free up cash flow, borrowing capacity, those sorts of things. I can't give you specific advice, of course, AJ, but I do like geographical diversification in a portfolio. So if you do end up selling one or two of your investment properties, the next purchase, it would make sense, firstly, to buy in a market that is not yet in a growth cycle, and whereas Brisbane arguably is kind of more than 50% of the way through its growth cycle. So to buy at the beginning of growth cycle, and then secondly, to get that geographical diversification. At the moment, people are going, oh, I don't like Melbourne, land tax, rental rules, all these sorts of things. And I get that, but the reality is these things change, right? So there's nothing that says other markets won't go through similar sort of challenges over the next 20 years. And they've all been through these challenges over the last 40 years. So these things come and go. Sometimes it's very pro-investment, sometimes it's anti-investment. As long-term investors, we've got to kind of ignore that a little bit, unless we form the view that it's going to be permanent like that, which I don't think you can do. So as a general sort of observation, I think the next step to have a property outside of Brisbane kind of makes sense for all those reasons. And the final question's about super, in terms of, do they maximize super or do they invest in ETFs or something like that? AJ's mentioned that his wife would like to be able to stop working in about 5 years, and the option for him to do that in about 10 years. Said he's mid-30s, that takes him mid-40s, 15 years away from being able to access super. So definitely I don't think super, given those goals, is a priority at this stage, and I'd be building a portfolio of liquid assets outside of super that then at least allows you to be able to access that capital income to be able to complement whatever other earned income you might have in your family, to give you the flexibility to either have a sort of staged transition into retirement or full retirement, whatever it might be. But really interesting scenario there. I think probably a lot of people can learn something from it. So thanks very much for writing in, AJ. Okay, next question is from Peter and Veronika. They say that they've got a unit, that's their home, in Rockdale in Sydney, worth about 800,000, that doesn't have a mortgage against it, 2 investment properties, one in Townsville, Two investment properties purchased last year, by the way. One in Townsville, they bought it for about 415. It's now worth over 500. I know Townsville done pretty well over the last 12 months. And then one in Ballarat, purchased for 440. Not much equity there yet. They would like to move out of that Rockdale unit in the next 3 to 5 months and rent invest in the Shire to go to a bigger place because they've got 2 teenage kids, again in Sydney. So the question is, should they sell that unit in Rockdale now and invest right away in a better market, or just rent it out and see if it's going to grow a little bit because of maybe interest rates and so forth, thinking that maybe the gap between apartments and houses might sort of compress. The challenge with rent investing as a strategy is that one day you're going to want to get back into the property market. Now, I hear or note that Peter and Veronika have 2 investment properties in locations that are probably likely, at a guess, to do okay for them. So they still do have exposure to property market generally, but not the property market that they might necessarily want to live in. So that is somewhere in Sydney, I'm guessing. And so if you're out of that market and those markets grow differently, and I would say that probably if you look over the next 20 years, Ballarat and Townsville will underperform markets in Sydney. Maybe not every single market, but as a general, if you look at median house price in Sydney or median apartment price in Sydney, I think it's reasonable for all the fundamentals that they're going to outperform. So the risk in the rent investing strategy is that you continue to get priced out of that market, which is a bit of a challenge, which would mean then I don't really want to go and sell the Rockdale unit because at least I've got a peg into that market, albeit for a property that, well, firstly, is not going to give you too much in the way of negative gearing, which isn't a big deal because you've got the other 2 properties. So it's sort of undergeared, if you like. And also, it's not going to suit your circumstances now, given you've got 2 teenage kids. So I would think really carefully about selling Rockdale and not replacing it. So that is, you might sell it and then buy something else in Sydney, or sell it and buy something else that you might like to move into after you've finished rent investing. And then the other caution is, will you rent invest for the rest of your life? Well, it's possible. But, the thing is, in the last 2 decades, I've met plenty of people and advised plenty of people that have told me, look, we're happy to rent for the foreseeable future. But I know, and every single time at some point they've come back and said, Stuart, we really need to buy a house now. So you always need to build that into your plan, even if you are of the mind right now to think, well, I'm happy to rent invest for the rest of my life. You've got to provide for some flexibility in your strategy in case your mind changes on that. So that's probably one of the key things. I wouldn't want to get out of that Sydney property market just because it could be too difficult to get back in there. Okay, next question is from Greg. Greg says, thanks for the podcast and books. I've gifted a couple of copies of Investopoly to people that have asked me for guidance over the years, and it's a great place to start, and often reread it myself along with Rich Dad, Poor Dad, which is a great reminder for my investment journey over the last 25 years. So thanks, Greg, and thanks for sharing the book. It's something, when I sat down to write it, it's something that I kind of hoped is that I could write something that is going to sort of stand the test of time. And because all the rules that I talk about in Investor are backed by evidence and fundamentals, they're not really going to change very much. So some of the examples or the data in there might become outdated in time, but the general principles hopefully don't change. I also read Rich Dad, Poor Dad many, many years ago, probably 3 decades ago. For what it is, but it is a bit of a thought-provoking book in terms of our emotions and psychology around money. So anyway, thanks for sharing. I appreciate it. Anyway, Greg writes, I'm towards the end of my financial journey, having recently semi-retired at 55, as I head towards self-funded full retirement over the next few years. But my question is about my sons. Both are in their early 20s, working/studying and saving for their first home, as well as some long-term investments. We have instilled some good financial disciplines early with them, being around saving 30% of their net weekly income before budgeting for everything else, in a 20-10 split, home versus investing. But up until now, 30% has been placed in a separate bank account from their day-to-day expenses as we started this when they first got a part-time job. But because it was in a bank account, they didn't earn very much in terms of investment returns. They now have a growing amount saved for their first home, 30 to 40,000 each. And I feel they should be placing that in something more effective than a basic savings account, and wonder what you would recommend. Given they both will want to access it in the short term, say maybe 3 to 5 years, possibly even up to 10 years maximum, would a term deposit be the best option, or is there something else to consider that would give a lump sum to be placed in it with additional amounts each month, quarter, or 6 months as allowed? Any guidance would be valued. Great question, Greg. It really is. I guess as a basic kind of rule, if you like, at least for now, we park all savings for clients in a ETF called HBRD. It's a fund run by Beta Shares. Actually, it's run by Coolabah Capital, which Chris Joy looks after. But it's an ETF that's promoted or put to the market by Beta Shares, and it invests in hybrid investments. Now, that's our strategy at the moment. That hybrid sector is going through a few changes in terms of regulatory changes. And so that market might end up shrinking. But for now, we're comfortable with it and don't expect that to change for the next couple of years. But just in case anyone's listening to this episode in 2 years' time, I just wanted to point that out, that advice won't necessarily be relevant forever. But HBRD invests in hybrid securities, which gives you a combination of income plus franking credits. And the grossed up return is north of 6%. Pays that every month. So it's a regular income stream, and the boys can invest more in that as they like. And I think it will beat a term deposit. And because it's an ETF, you can sell it today, and in 3 days' time, you'll have the money in your bank account. So call it at call if you like. So it's a pretty good return. There is some capital volatility in there, very, very small. But the longer you hold the investment, the lower the probability you're going to lose capital. But I'm talking, really small. If you look at situations like COVID in early 2020, it did drop, but then did recover the amount. So it's not as safe as a term deposit. But again, I think for the purposes we're talking about, I think it is a good place to sort of park savings. Now, the question then is, do they do something a little bit more aggressive than that? Because they're going to get 6.5% from that investment. Well, possibly, if I've got a time horizon of 3 to 5 years, possibly up to 10 years. I mean, the difficulty is when you're young is to pinpoint exactly when will you buy and what does all that look like. But I reckon maybe they could take some risk with the money. So maybe, if they've got 40 grand, if one has 40 grand, maybe you put 30 in HBRD. Maybe you take a little bit of risk with the other 10, depending on, everyone's going to have different risk profiles or whatever, but just as an example. And then you could put that in a diversified ETF, such as DHHF or even GHHF with gearing. Again, that's a little bit more high risk again. But I think, taking at least exposing some risk and also giving them an experience to investment markets. One of the great learnings is a bit of volatility, and then having the self-discipline to ride out that volatility. So in a way, it's not so bad. It can't be sort of a straight line example, but good on you, Greg. Good on you for teaching even just the basics around cash flow management. That is the ticket to the dance, if you like. You're not going to be able to build wealth if you can't manage cash flow. If you're going to spend everything you earn, there's nothing either myself or anyone can do for you to sort of help you get ahead. So it really is sort of carving off that amount every month and regularly investing and having that discipline. So if they've got that, they're miles in front. So thanks for your question, Greg. Okay, next question is from David. It's a pseudonym. It's not his real name, but anyway, it doesn't really matter to you, the listener, does it? Anyway, so I'm not really sure why I mentioned that. But anyway, it's a really good sort of thought-provoking question, a very interesting one, in fact. Anyway, I will just sort of summarize. David's got a home, no debt, and 2 investment properties, no debt. And he said that there's some finance commentators out there that say, when you've paid off your investment property, you should sell it and then go and invest in ETFs or something like that, given there's no leverage left against the property. And David's saying, well, I like keeping the property for a couple of different reasons. Firstly, there's some diversification. You're invested in sort of an asset class that's a little bit different. And I should mention David's got super and an ETF portfolio that's invested across, Australian, international shares, bonds, cash, all those sorts of things. And then the other consideration is a capital gains tax. Of course, David plans to retire before he gets to super pension age. He's got other investment income. So either way, whenever he sells this, he's going to pay a big whack of capital gains tax. And the main point he's sort of saying is there's not too much commentary around what level of diversification does property provide in a portfolio. And I think it's a fantastic question. Okay, so let's talk about the first thing in terms of lack of leverage. Because I've got a bunch of clients actually that own property with no debt against it, right? So it's not about leverage. Leverage helps us get into the market. Leverage helps the holding costs of being able to, invest $1 million of someone else's money, and leverage then gives us, the negative gearing benefits sort of defray some of the cost of the holding costs and make that a more palatable investment option. But it's not really, and that's why, getting started, that leverage helps. But in the long run, it's all about compounding capital growth. So if my investment is returning more than, say, 7% on average over long periods of time, and today I own a property that's worth $2 million with no debt, well, in 10 years' time, that property, if we average it all out, should be worth $4 million. That property is going to increase then $200,000 a year for the next 10 years. And once that's done, it'll double again to 8 million. So then I've got, 400,000 a year on average of capital growth. That's a great return. Why would you sell an investment that is delivering that return just because you don't have any debt, right? So I think it's a misunderstanding by commentators because the debt is very powerful to allow me to get into the market. But once I've got a foothold and I've built an asset base, the leverage can still help me, of course, but it doesn't necessarily justify the investment. It's really that compounding capital growth that is really good. So if I had an under-leveraged asset like 2 investment properties without any debt, the thing that I'd be thinking about, do I want to hold them, is I've got to form a view on what the future capital growth will be. And as I said, if they're going to double every 10-ish years, and they're going to go through flat cycles, of course, so they're not going to do that every single time. But on average, then I'm keeping those assets most likely, unless I need some liquidity. And of course, in David's situation, he doesn't. But his main question is around when building and constructing a portfolio, how does property play into that in terms of diversifying returns? And I think it's a really interesting question. There's a couple of different observations there. The first one is that property has half the volatility of shares. Now, I guess we know that sort of intrinsically or, just as a sort of general observation, we know sort of property tends to be a little bit more stable. But I guess from a technical financial planning perspective, what you're doing is reducing volatility in the whole portfolio by introducing property assets. And I think that's kind of good. And it's lower volatility as we get closer to retirement, makes us feel more comfortable. Having said that, the counter argument to that is volatility is more of a education piece than a financial planning consideration, because I would rather maximize my returns over the next 20 years and weather the volatility, I'll just stop looking at my balance, than, change the asset allocation to reduce volatility at the cost of returns. That's just my personal viewpoint, and that's why I think it's more of an education piece rather than an asset allocation decision. But certainly volatility will reduce the volatility in the portfolio. The other thing is correlation, and that's an interesting one. The general principle, and it was true except for the COVID period, is that bonds are negatively correlated with shares, which means if shares have a great year, bonds tend to not have a great year, but the reverse is true as well. And so by introducing bonds to a portfolio, you reduce the overall portfolio's volatility. And hopefully by investing in assets that are negatively correlated, you're going to have any one particular year, some of your investments are going to win and some of them are going to lose, and that kind of smooths it all out. There's no correlation with residential property and shares or bonds or anything really. It is a law unto itself. And maybe that's something, and I remember doing that analysis when I was writing the book Investopoly many years ago. And I don't know if I actually commented on that in the book, but that is the reality. Actually, there's no correlation with these other assets. And I guess we can look at it because property is influenced by a whole heap of different factors. Because if you think about it, we've had relatively high interest rates for the last couple of years in Australia, and you've got some markets like Melbourne that are struggling and other markets like Perth that are going gangbusters. So you can't even draw sort of macroeconomic sort of data or indicators or rely on those sorts of indicators to be able to predict price movement. But I think it's kind of interesting. Now, if I am in a situation, do I want to introduce property into a portfolio, or am I let me put it a different way. Am I uncomfortable if I have a client that doesn't have any property exposure once they've already built their asset base? You know, if they've got $2 or $3 million of net worth, am I worried that there's no property there? No is the answer. Generally, no. I'm not going to change a portfolio and introduce property to it, even if it's ungeared, just for the sake of having that property exposure. I think leverage is a great thing to help people get started, and property does that really well. I think the fact that most of the return is going to come in compounding capital growth rather than income certainly suits people in accumulation phase. So I think that does well. I think if people are already into property, as I talked about at the beginning of this answer, and they get that compounding capital growth, I think that really works well. But I don't think there's any, my opinion is that there's no fundamental financial planning or asset allocation reason that we should have property in a portfolio. It's really just a case, I think, of what past decisions, and I certainly don't worry about the gearing. But I thought it was a really interesting question. You know, up until I wrote Investopoly, I hadn't seen any analysis around the volatility in property markets and going back and sort of calculating the volatility, which I did in Investopoly, or looking at correlation, which again I did in when I wrote Investopoly as well. And I think it shows that as a general rule, the commentary and analysis around property as an investment strategy is really lacking compared to the commentary and financial analysis in the share market. You've had a whole bunch of people for many decades pulling it apart, different strategies, different approaches, all those sorts of things. There's a lot of robust information out there, but there's not for property. And it's kind of what I'm hoping, a gap I'm hoping this podcast fills. So even though we're agnostic around asset classes, I definitely am, I think there is a greater missing piece of the puzzle with greater lack of information, a better way to say it, with an independent analysis with property and property investment strategies than there is on the shares and super side. Anyway, thanks for your question, David. I'm glad you're enjoying the podcast. And of course, thank you to all the listeners that write in and submit these questions. I really do enjoy answering them. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.